Do you know Warren Buffett?
Nggak tahu.
Ponakannya nggak tahu Pak.
Bu, do you know Warren Buffett?
Yes.
Do you know Warren Buffett? Sir,
Yes,
do you know Warren Buffett?
yes, I do.
Who is he?
Warren Buffett is that you put your storage and everything in the buffet.
Do you know Warren Buffett?
Yes, I do.
Who is he?
One of the billionaires who likes reading books.
Aha, this is the right person to ask about Warren Buffett. Hi, Vena.
Hello.
Hi, do you know about Warren Buffett?
Yes, of course. Actually, today I would like to meet my friend to discuss about his book, the legendary book.
Warren Buffett was born on August 30, 1930 in Omaha, Nebraska, United States. Since he was a child, he was fascinated by numbers. Before he entered kindergarten, he was already a calculating machine. Warren Buffett's education is a synthesis of three powerful figures: Benjamin Graham, Philip Fisher, and Charlie Munger. Benjamin Graham is the most influenced person on Buffett's investment life after his father. Graham, known as financial analysis, best known for security analysis and the intelligent investor. The essence of security analysis is that a well-chosen diversified portfolio of common stocks, based on reasonable prices, can be a sound investment. Philip Fisher graduated from Stanford's Graduate School of Business Administration and started his career as an investment counselor. He witnessed the stock market crash in 1929. He started his own counseling firm in the early 1930s. The third person who influenced Buffett is Charlie Munger. The relationship between Charlie and Buffett was evolved over the years, though it was not formalized in agreement. The two made many investment decisions together and their business became more interlinked. Charlie also brought an intellectual perspective of financial knowledge, background in law, and appreciation of lessons from other disciplines.
Financial tenants have four critical financial decisions that the company must maintain. Number one is return on equity, to measure a company annual performance. Number two is owner earnings. Number three is profit margin. And number four is the $1 premise. Market tenants have two interrelated cost guidelines. Number one is determine the value. And number two is buy at attractive price. Buying a stock only when the difference between its price and its value represented a margin of safety. That's called the margin of safety principle. And how to become an intelligent investor and a smart investor is we have to thinking. For owning a share of stock, it seems like owning a business, not only a piece of paper. So that means we have to knowing and understanding the company and its business field is moving, as well as the risk to the market and industry. Also, Buffett say in buying company, avoid commodity businesses and managers in whom we have little confidence, and purchase company that we understand. One that possesses good economic and is run by trustworthy managers. Number two is management tenets. Management tenets has three important qualities that senior manager must display. Number one is rationality. Rationality is the manager quality. To think distinguishes the style with which manager runs company. And the most management act is the allocation of the company capitals, deciding what to do with the company earnings, reinvest to the business or return the money to the shareholders. Number two is candor. Candor is financial performance that fully and genuinely who admit mistake as well as share success, and are in all ways candid with shareholders. For example, approximately how much is the company worth, what is the likelihood that it can meet its future obligation, how good a job are its manager doing, etc. Number three is the institutional imperative. tendency of corporate managers to imitate the behaviors of others, no matter how silly or irrational it may be.
Hi, can you guess what kind of product that Warren Buffett invests? Let me check. Can you guess what? This is the product that Warren Buffett also invests. It's produced by Heinz ABC or Heinz ABC. Chapter 4, the book discusses about the 9 companies that become the investments of Warren Buffett and part of the applications of the 12 tenets that we already discussed in chapter 3. It is the ranging from the newspaper or media, and then food and beverages, insurance, banking, and also the computer. And then one of the interesting to be discussed in this book is Warren Buffett also invests in the military defense company. So the first company that discussed in this book is the Washington Post. That's the newspaper, legendary in America. And then the second one is the Geico Corporation. That's the insurance, government insurance to be exact, government insurance for the employee. And then the third one is the Capital City, or under or ABC under Tom Murphy. And then the fourth one is the Coca-Cola company, which is a beverages company, and then one of the biggest have a long history with Warren Buffett. And then almost all the 12 tenets that Warren Buffett have apply in this company. And then the fourth one is the General Dynamics. That's the military defense company, defense contractor actually under McDonnell Douglas company. The number 6 is Wells Fargo and Company. That's a bank company. The 7th one is American Express company. American Express as a banking and a credit card company. Number 8 is the IBM, International Business Machine. You know the development of the computer. IBM also have a long track record in developing this industry. That Warren Buffett invests is the food company H.G. Heinz Corporations. And then if you know the product in Indonesia is ABC Sambal. That's also one of the product that part of the H.G. Heinz Corporation's investment. So that's all the 9 company that Warren Buffett willing to invest. And then the applications of the 12 tenets, not all the applications of the 12 tenets is applied in each of the company. But if we are talking about the Coca-Cola company, almost 12 tenets, starting from the history, and then not all 12 tenets that Warren Buffett have is applied for the company that Warren Buffett invests. That's discussed in this book. But except for the Coca-Cola company, almost 12 tenets is applied for this company. starting from the simple and understandable the business. And then consistent operating history, Coca-Cola already invented or manufactured since 1886. And then favorable long-term prospect, and then also have high profit margin, return on equity, and then the willingness of the management to develop this business also become the big considerations of the investment in this company. Owners earning, institutional imperative, and then also value of the business at that time is really high, but at that time the stock price of the Coca-Cola is really under performance. So the buying at the attractive price is also become the big considerations before Warren Buffett invest in this company, and after that have around 7% of the share of this company. You can find the applications of the 12 tenets almost all happens in the Coca-Cola.
Chapter 5. Portfolio Management, the Mathematics of Investing. Buffett says the ideal portfolio should contain no more than 10 stocks, if each is to receive a 10% weighting. Yet focus investing is not a simple matter of finding 10 good stocks and dividing an investment pool equally among them. How long is that ideal time? There is no hard and fast rule, although Buffett would probably say 5 years, since this is the time period he is focusing on for Berkshire Hathaway's results. A 10% turnover rate suggests that an investor holds the stock for 10 years, a 20% rate implies a 5-year period. However, the margin of safety approach, while crucial, is not sufficient in itself. We must also take into account 3 important portfolio management constructs that Buffett has developed. 1. His way of building a portfolio for long-term growth. 2. His alternative measuring stick for judging the progress of a portfolio. 3. His techniques for coping with the emotional roller coaster that inevitably accompanies portfolio management. In the reality stock market, the chain thinking of stock market is the same. 1. Calculate probabilities. 2. Wait for the best odds. 3. Adjust for new information. 4. Decide how much to invest. Chapter 6. The Psychology of Investing. Warren Buffett's first common stock investment was a disappointment, both financially and emotionally. He did learn 2 very important lessons, that is, 1. The value of patience. 2. Short-term changes in stock prices may have little to do with value, they can have a lot to do with emotional discomfort. When it comes to investment decisions, our behavior is sometimes erratic, often contradictory, and occasionally goofy. To fully understand the markets and investing, we now know we have to understand our own irrationalities. This blending of economics and psychology is known as behavioral finance. Ben Graham's known as the father of financial analysis when teachings on psychology and investing, both security analysis and the intelligent investor. Graham devoted considerable space to explaining how investor emotions trigger stock market fluctuations. Graham figured that an investor's worst enemy was not the stock market but oneself. As Warren Buffett explains, there are 3 important principles to Graham's approach. 1. Simply looking at stocks as businesses, which gives you an entirely different view than most people who are in the market. 2. Second is the margin of safety concept, which gives you the competitive edge. 3. Having a true investor's attitude toward the stock market. Why psychology matters. It is people who make markets because emotions are stronger than reason. Fear and greed move stock prices above and below a company's intrinsic value. When people are greedy or scared, Buffett says, they often will sell stocks at foolish prices. In the short run, investor sentiment, human emotion, has a more pronounced impact on stock prices than a company's fundamentals. When it comes to investing, emotions are very real, in the sense that they affect people's behavior and thus ultimately affect market prices. 2 reasons why understanding the human dynamic is so valuable in your own investing. 1. You will have guidelines to help you avoid the most common mistakes. 2. You will be able to recognize other people's mistakes in time to profit from them. Conclusion is the only antidote to emotion-driven misjudgment is rationality, especially when applied over the long haul with patient perseverance.
Leo Tolstoy made this profound observation: the strongest of all warriors are these two. First is time, and the second is patience. Warren Buffett clearly stated that all market activity lies on a time continuum. Whether chosen in investing in short-term or long-term frame is highly dependent of the culprit. Warren Buffett, may go without saying, sits comfortably on the right, quietly patient over the long term. The critical difference in investing also lies on rationality. Rational persons think clearly, sensibly, and logically. Even though there is ample evidence that long-term thinking, patiently applied, is the best course for investing success, it appears that nothing much has changed. Financial crisis and bear market haven't changed our behavior. Time and patience, two sides of the same coin, that is the essence of Buffett. His success lies in the patient attitude he quietly maintained toward both Berkshire's wholly owned businesses and the common stocks held in the portfolio. He held Coca-Cola for a long time with patience. Warren Buffett is often called as the world's greatest investor. It can be measured by 2 simple variables: relative outperformance and duration. Both are needed. It is not enough to just beat the stock market over the short run. Countless people have done at one time or another. Doing so over a long period of time is what counts. As Warren Buffett started it from managing money when Dwight Eisenhower was president and continues to play the game in almost 6 decades later. How he navigates their journey in investing is interesting to know. With his foxy style, he confesses that he simply tries to be greedy when others are fearful and fearful when others are greedy. Studying Warren Buffett, we can see each of these 3 components at work. First, behavior advantage. Successful investing does not require having a high IQ or taking the formal courses taught at most business schools. What matters most is temperament. And when Buffett talks about temperament, he means rationality. Second is analytical advantage. Warren Buffett sees a business while most investors see only a stock price. While other investors were busy studying capital asset pricing models, beta, and modern portfolio theory, Buffett studied income statement, capital reinvestment requirements, and the cash generating capabilities of the companies. Third is the organizational advantage. The success of Berkshire Hathaway rests on 3 fundamental pillars. First, the company's subsidiaries generate mountain loads of cash that are sent upstream to corporate headquarters in Omaha. Second, Buffett, the capital allocator, takes this cash and reinvests it into more cash-generating opportunities. Third, the last pillar is decentralization. Each of the subsidiaries is managed by very talented operators who need no help from Buffett to run their businesses. In short, Buffett's management manifesto can be summarized as hire well, manage little. Hire well, manage little. We have come to understand about Buffett is that he is continually seeking patterns that can be found when analyzing a business. He also knows that these business patterns will at some point reveal the future pattern of the stock price. Then, finding our own way is the journey in investing. That's the point of these books. Good day.